This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
South on in April of 142!
Warren Buffett.
Carl Icahn.
John Templeton.
Buy low, sell high. Fear, that's the other guy's problem.
Dan Druckenmiller.
George Soros.
Paul Peter Jones.
Peter Lynch.
I wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
My guest for this episode is Simon Mikhailovich. Simon is the co-founder and manager of the Tocqueville Bullion Reserve. And in this conversation, we discuss everything from his experience growing up in the Soviet Union and emigrating at 19 years old to the end of this great debt supercycle, what it means for the prices of financial assets, and finally how gold represents the ultimate insurance policy during this time of uncertainty. So without further ado, please enjoy my conversation with Simon Mikhailovich. Simon, welcome to the show.
Thank you, Jesse. Good to be here.
Yeah, I'm really excited to have an expert on the topic of gold to talk to. It's something I haven't done with a podcast yet, and I'm really eager to talk to you, about that as an issue specifically. But let's start at the beginning. You have a very interesting background. You grew up in the Soviet Union. I
did. I grew up in Leningrad, which is now St. Petersburg. And left in 1978 when I was 19 with my family. They let us out with $100 a piece and a suitcase of of precisely 20 kilos. And it wasn't the proverbial $100. It was actually $100 a piece because that's what the capital controls permitted you to exchange into hard currency from rubles. So that's how I ended up coming to the West with $100, a suitcase, and then two grandmothers and two parents who didn't speak any English.
Right.
And they had $400 with them and 4 suitcases. So that was, but probably bigger liability than an asset, other than, of course, filial, family pleasures, but from a financial point of view. Anyway, so we left because for a lot of obvious reasons, but also because concluded that, the system really didn't work. It was visible that it didn't work. In retrospect, that period of the 70s and 80s is now called stagnation. But at that time, of course, nobody knew that that's what it was, but that's what it felt like. And, given the corruption and what else was going on there, we just decided that there was no future. And so we left at a very high cost of leaving absolutely everything behind, and also giving up citizenship. That was a condition because you were a traitor for leaving the motherland. So you had to renounce your citizenship and pay dearly for that too. So we showed up in the West essentially as refugees with $500 between the 5 of us and no citizenship of any kind, no papers. Ended up in the United States. Yeah, go ahead. You were going to say something?
Well, yeah, I was just going to say, obviously that experience had an impact on you and the capital controls on your thinking about money and stuff these days. But you use the term stagnation, and I just think of the term secular stagnation has become really popular to describe developed economies today. You saw that history, kind of the tail end of the Soviet Union. And are there parallels to what you're seeing today in the United States?
Well, no, there's no question about it. That's why I ended up doing what I'm doing. I'll tell you the rest of my background, but I see a lot of parallels. And of course, you can't compare, like they say, history doesn't repeat itself, it rhymes. You can't compare the Soviet Union to the United States on almost any front. But in the trajectory and substance of a lot of things that I'm seeing, or lack of substance in a lot of things that I'm seeing, whereby there used to be substance, is pretty striking. This is how I ended up coming to gold in the first place. But maybe I can just sort of tell you the rest of my history and
please.
Illuminate. Yeah. So anyway, so we came here and I ended up working my way through college and then working my way through business school. and then ended up in the investment business. And the first 13 years I spent on the investment side of an insurance company. So I have background in things like workouts and private placements and real assets, and also insurance, and understanding how insurance works and the issues of what to look for and so forth. And then in 98 or by mid-90s, I got involved while working at that company in something called CDOs, collateralized debt obligations, of which, of course, no one had heard at that time. And when the company was sold in 98, my then colleague became my partner, my business partner, and we bought from the company that purchased the company we worked for, the CDO management business, and started in the CDO business. So basically, of the 5 years that I've been investing, I guess about 20 years or so was spent in credit and credit derivatives, and these new technologies, some of which have eventually led me to what I'm doing now. And so in 06, we did very well through the distress cycle of 04 or 3 through 5, I guess, buying distressed CDO tranches. Once we figured out what that technology was all about, we thought, of course, it was going to be dead. We didn't realize that Wall Street was going to pick it up and make it bigger than ever. And so we started seeing the next crisis coming in about 06 and raised funds for that to take advantage of what we saw was the coming distress in this hyper-levered, completely misunderstood, difficult to evaluate space. And we also, of course, looked at subprime mortgages and both credit and subprime mortgages. And that's when I personally became interested in gold, because what I saw was going on with the financial system and the derivatives and the role of the derivatives in the financial system, and also understanding how insurance works and seeing how AIG and some other companies were selling this protection essentially for nothing against potentially catastrophic risks just because they didn't think this was ever going to happen. It made it look like something was not quite right. And so I started on a personal level preparing and, as a business positioning for that. And of course that paid off. I mean, it was a painful wait, but it paid off very well in 08, 09. And then we were able to take advantage again of the distressed opportunities. But by about 2011, I've kind of felt that the credit story has played itself out. Of course, it continued to get even more ridiculous, not that there was any value in the last 5 or 6 years. But I started slowly transitioning into something else, and my thesis there, it wasn't about gold really. It was mostly looking for how do I take a portion of my savings or everything that I've accumulated over the years and put it in some form that would A, be liquid, and B, independent from the financial system and financial infrastructure and cyber immune because of all the digitization and the digital threats. And so that's how I ended up becoming interested and then involved in gold, when I also realized that it's not that easy for people to actually buy it, sell it, transport it. And so it was more personal interest that led me to it, or a lack of solutions for myself that led me to it than anything else. So that's like in 3 minutes or whatever, 5 minutes, the background.
Yeah, no, perfect. And so you were looking for basically an insurance policy against risk in financial assets, is that it? And so you came across gold.
Right. I mean, when people say insurance policy, I mean, most people buy insurance by, they see the ad in the paper and it says, call Geico and we'll save you 15% or more. And so they call and they buy this policy. They don't really know what it says. And the vast majority of the people, at least in my experience, have never read their insurance policy. So they don't really know what's covered, right? And they find out what's covered is when the actual event occurs, then they go into the policy. Then sometimes it turns out that it just so happens that particular thing was not covered. So when you understand insurance, I mean, you really have to understand what risks you're trying to insure, and whether whatever it is you're doing, or however it is you're doing what you're doing, actually protects against those risks.
Yeah. Well, that's what I want to ask you about. It's funny to me that you bring up Geico, because we just had the Berkshire Hathaway annual meeting, and what is it, 40, 50,000 people flock to listen to Warren Buffett talk about these businesses and others. But he's famously, while he's very successful in the insurance business, he very famously said, he doesn't see gold as that insurance policy. What in your view makes gold a necessary part of a diversified portfolio, and what is it specifically that makes it valuable as an insurance policy?
Well, I mean, first of all, let's just step back and take a look at what you can't come up with the idea of an insurance without understanding what the risk is. I mean, it's like the solution it cannot be discussed without discussing the problem, right? Because the solution is informed by the problem, not the other way around. So everybody's very focused on gold, and they either say they don't understand gold or they don't believe in gold. But to me, this discussion is completely not about gold at all. It's really about what are the risks, and if you don't understand the risks, then you start thinking as to what are the ways to ameliorate those risks, and that's when you stumble on something like gold. So I think that any discussion of gold, at least from the way I'm looking at it, yes, of course, there are people who are emotionally attached to it. There are people who are called gold bugs who have, philosophical, strong philosophical ideas about how gold should be money and legal tender laws and all things like that. But that's not what this is about for me. I mean, yes, some of that makes sense, some of it doesn't make sense. But what the way I got there is by looking at the financial system, by the risks of the financial assets, and understanding sort of what the potential outcomes could be, and only then asking, okay, so if there were a solution, what would it look like? And then you would have to say, without, if you say the risks are the fact that all financial assets are digitized, there are no, you don't have real certificates. We saw what happened in 2008. There were only 3 failures of major financial institutions that were not bailed out. And that was Lehman Brothers, Refco, and MF Global. These were all 3 broker-dealers, meaning that they held securities in custody for people. Now, holding securities in custody is not supposed to be a risky activity. So when you have your securities in somebody's custody, you're not expecting to lose those securities if something even happened to the institution that holds it, because all they're doing is they're holding it for you. Well, that wasn't true. People lost money in all 3 of those cases just from custodial assets, because the custodial assets were digitally held. They're held in street name. They were being used for what's called rehypothecation, means they were lent out and then re-lent out further to other parties. And when collapse happened, there wasn't enough for everybody to go around. So, that's one of the risks. And then, of course, you step back and you say, well, we've been in a very specific time frame over the past 30, 40 years when interest rates have gone from, 20% or something, 19, 18%, down to virtually zero. They're now getting off the floor, but they're still, by historical standards, almost close to 5,000-year lows. And as you very well know, the way all financial assets or all cash flow producing assets that Warren Buffett likes so much are evaluated are by using discount rate and present value formula, which the main put into which is a discount rate, which is an interest, which is based off of interest rates. So if the interest rates are near 5,000-year lows, just mechanically, just through the way valuations are done, means that the asset values for financial assets are near 5,000-year highs. So why would that be a good idea to buy something at 5,000-year highs? Is that how you make money, or is it buy low, sell high, or it feels like the other way around, right? So that's just one dimension of thinking. And then, of course, you have to say, if you look at the economy over the past 35 years, and you say, well, yes, the markets have gone up quite a bit, but the incomes in real terms for the vast majority of the people have not. And I saw recently, I don't know if you saw that chart of Deutsche Bank, showing the percentage of votes cast across major economies for populist politicians and populist parties. that index is back to the level where we last saw in the 1930s, in the 1940s. Clearly a period of tremendous economic distress, which we're not visibly experiencing right now. But clearly for a lot of people, things are not the way they seem for maybe a lot of other people that don't see the problem. And so there's a political dimension to what's going on. There's a sovereign dimension to what's going on because the United States is borrowing at a rate of, I don't know what, we're about to borrow another $1 trillion or something like that. We've doubled the debts. Everybody knows about the debt problem, right? But they don't think it's a problem because it's been going on for so long. And they think it'll go on forever. So I agree. There's no debt problem. There's a debt interest problem because you have to service the debt. And you can't service it with accounting entries. I mean, you actually have to pay the coupons. And that's true for corporate debt as well, which, by the way, is also at an all-time high. And with the rates going up, I mean, you see that. I mean, we can just go on and on. I mean, please stop me here because...
Yeah, I think you made a point in something else that I was, one of your other presentations, that, during that era of declining interest rates, you can add more debt and it doesn't cost you anymore because the interest rates are coming down. But now that dynamic is over, adding more debt becomes more costly. And so that's where you have an inflection point where things can become problematic.
I think you're absolutely right. I think the inflection point was passed around 2011. But because rates are so low, I mean, you just people don't need to do any heavy math. If you just it's arithmetic. You just think about it and you say, well, if I can make the same monthly payments and owe twice or 3 or 4 times as much money, what difference does it make how much money I owe, as long as I can pay the monthly payments, and as long as the maturity of the debt, I don't have to repay this debt either for a very, very long period of time, or I'm confident enough that I can refinance this debt at any time at a reasonable rate. So if you think of it in those terms, people don't see the problem. But in 2011, what happened was we were paying in 2011 as little in interest debt service. By we, I mean the federal government. But United States, as the U.S. was paying in 1998 with 1/3 the debt. So 3 times the debt, the same amount of interest payments. But if you fast forward to 2017 fiscal year, the U.S. paid the highest ever interest expense on obviously the highest ever debt, but at the lowest ever rate. 2.25%, I think, or less than 2.25% on average was the debt service rate on the debt. So, and now the rates are going up. So the budget, which already spends 30% of income tax collections on debt service, I feel like it's almost like a coiled spring, because you could have really a real acceleration of debt service, and then which means that the government has to borrow even more money than it's borrowing just to pay the interest. And we're already cut the taxes and, did whatever we did in the past. Yeah, go ahead.
Right. No, I was just going to say, we cut taxes. And so now, what was the first quarter, Treasury sales were the largest on record to try and, fill that rising budget gap, even as, interest rates are rising. To me, it's a very interesting time. Also, I interviewed Bill White, who was the chief economist for the BIS. And he brought up a very interesting point to me. He said that, basically over the last 35 plus years, the Federal Reserve has been able to pursue kind of whatever monetary policy they want because the fiscal authorities haven't been too out of control. And but now we have one of the longest economic expansions on record, and the fiscal authorities are getting extremely aggressive. And there's a paper, I think it's called Some Unpleasant Monetary Arithmetic, that Bill turned me on to, and basically it points out that the federal or the central bank can essentially afford to pursue aggressive policies so long as the fiscal authorities don't do the same. But as soon as fiscal policy starts to overpower monetary policy, it puts you can really stoke inflation, especially when you're dealing with a government that has a lot of debt. And I think that's exactly the scenario that we're looking at right now, where the Federal Reserve has been able to pursue incredibly easy stimulus because the federal government has not been doing too much. But now we get these tax cuts and these other things going on. With a 3.9% unemployment rate, you're going to get, I think we're starting to see some real inflationary tendencies taking off, and that's going to put the Federal Reserve in a bind. But it also, for me, it answers the question, why should, financial assets come down in value over the next 10 years, especially relative to real assets? Because you look at that chart that I think we've all seen, and real assets, especially gold, are cheaper relative to financial assets than almost any time in history. And that dynamic has come about from falling interest rates, like you pointed out. Lower discount rates and financial assets all go up. It's made real assets less attractive. What are your thoughts on? I mean, this, I guess, a new inflationary impulse and the bull case for gold over the next 10 years.
Well, my case for gold, well, two things. One, I agree with pretty much everything you're saying. I would add to what you're saying the demographic situation. We have 10,000 people every day turning 65, baby boomers. Social Security system until now has been cash flow positive, which means that the FICA and payroll taxes that it collects were enough to cover the outflows for pensions. I think like in the next 12 to 18 months, the Social Security is going to go cash flow negative, which means that it will have to pay out more than it takes in. Now, the Social Security Trust Fund is funded with U.S. Treasuries. So that means that the trust fund is going to have to start selling down some of these treasuries in order to pay the pensions, which is a version of a run on the bank, right? Where all of a sudden the cash needs, the cash needs would exceed the receipts. Now you have to start liquidating the capital. So what does it mean selling treasuries? It means that the government needs to borrow even more money just from that because it has to refinance this debt that's all of a sudden being tendered, or somebody has to buy it, or the government needs to refinance it. So I would add that to that. I also I took a little bit of an agnostic view on that, and the reason I do that is because from a risk management standpoint, everybody's very focused in our financialized world on the next best, on the next trade, on the next way, like where the prices are going. I don't necessarily think of gold or bull market and gold in terms of its price. I think of it in terms of its relative purchasing power. Because, people say gold is going to 10,000, gold is going to whatever, some number. What do they really, what does the world look like? What does $10,000 buy in that environment necessarily? Then some people say, well, but if there's a deflation, then gold's no good because then you should have the dollars. Okay, so in 1930s, that's what happened. The dollar, of course, the dollar was devalued at that point. So there was a moment when you would do well with the dollars. There was a moment when you would do well with gold. But even aside from that, when the President Roosevelt took over, they closed, I forgot how many banks, like 4,000 some banks were put on a bank holiday. And when the holiday ended a week later, less than half of the banks reopened. And basically the rest of them went bust. So when people say that the dollar is going to be, the purchasing power of the dollar is going to rise in a deflation, or rises in a deflation, well, that's not necessarily your dollars, because your dollars may be in a bank that doesn't reopen, or because the government decides to devalue the dollars if they can't generate the inflation that this inflationary impulse that you and I just were talking about actually pans out. What if it doesn't pan out? So I view the wealth preservation here at this moment is by assessing the risk and not trying to necessarily bet on any particular outcome, but just realizing that financial assets, the purchasing power of financial assets, has to deflate relative to real assets because they have been overproduced. It's just like it's like in industry, when you overproduce inventory, it has to be liquidated. But liquidation of inventory, if it's financial assets, essentially destroys savings, destroys pension funds, destroys everybody who accumulated some wealth or some savings or whatever. And nobody wants to think about that, or nobody wants to contemplate that. But that's essentially, you can call it what it can come about in many ways. But the problem is that if you lose either access to your assets or purchasing power of these assets, then the question is, so what stands a better chance to preserve purchasing power relative to other things? And you can name a whole lot of real assets that can do that. The problem is none of them are either liquid or feasible to own. I mean, you can say, oil will always be oil and useful, but how do you store oil? I mean, oil is, what is it, $60 a barrel? A barrel is a 150-gallon drum. And there are 27 different grades of oil, and it's toxic, by the way. It's very corrosive. So how do you own that? And you look at copper, copper is cheap. You need tons and tons and tons of copper. And of course you can go to land or you can go to other things, but none of that stuff is liquid then or movable. There's a reason why for 2,000 years or 2,500 years, people have come to gold as a reserve asset. There's a reason why 10% of central bank reserves are in gold. And there are good reasons why Chinese and the Russians are buying gold hand over fist. I just saw a statistic today that over the past, since 2009, so over the past 9 years, as the central banks have been buying gold that they have sold back, 60% of that is purchases by Russia. Because Russia is seeking independence. It feels under threat. And I'm not passing any judgment about, who's right, who's wrong in that fight. I'm just making a factual observation that Russia is under threat of financial warfare, or is having financial warfare conducted against it, financial repression, by being cut out of, being threatened to cut out of SWIFT, by sanctions on Russian assets and things like that. And so it feels vulnerable. So what is it looking for? Why is it buying gold? That kind of brings us full circle to what I said. So what do I see in gold? There are three things that I see in gold. One is it's scarce. It's genuinely scarce. It's like you and I talked about we started recording, some of the cryptocurrencies. I mean, yes, some individual cryptocurrencies may be scarce, but there's no scarcity of cryptocurrencies in general. They can be replicated, without limit. And even certain types can fork many, many ways and be replicated. Gold cannot be printed or replicated. It's something that's genuinely scarce and getting scarcer. It's permanent. We don't know. I mean, objectively, even the people who are complete head over heels with crypto assets, and I'm not passing judgment. I'm just making a factual observation. There is no basis that anybody has today, fundamentally, to suggest that 20 years from now, any of the crypto assets are going to be around, be valuable, or which one will be around and which one will be valuable, or 10 years from now, or 5 years from now. We just don't know yet. It's too early to say. I think gold, given the 2,000 whatever year history, I think if you have to make some educated guess, I would say that it's a good guess that it's still going to be around. Well, we know it's going to be around, whether it's going to be valuable or not, but it's definitely going to be around. And the final thing is independence. So it's scarcity, it's permanence or resilience, and the last one is independence. Gold is genuinely independent from everything. I mean, depending, of course, how you own it in different ways, depending on the quantities and so forth. But, a piece of gold does not rely on anything and anyone. And if I give you a gold coin or you give me a gold coin, I mean, that's the end of the transaction. There's no blockchain needs to go through a block and mine the block to prove what you and I just did. Neither does there need to be a record of this for posterity to be researched, 10 years from now or 5 years from now or at any time. So in that sense, gold is unique. It is the only financial asset. It is the only financial. I've done a lot of search for alternatives. It is the only financial asset that is universally liquid and completely independent from financial systems, markets, cyber networks, completely cyber immune, and liquid and feasible to own. So when you add those qualities together, it's very interesting in certain circumstances, like we have now.
Right. And to me, that's how you define a store of value. It's exactly those three things: the scarcity, permanence, independence, and it's also what to me, just makes it obvious that the cryptocurrencies aren't a store of value. And I'm fine saying that, even though
right.
the crypto guys might want to pay me back for that. But I want to also, you make a great point. And I think a lot of people don't understand this about gold, is that anything else you put your money in is going to be somebody else's liability. Almost anything else, besides gold. And so, I think that's probably how you came to gold. And from just hearing you talk about it, you look at what are the risks, what are the counterparty risks in anything that I own. I mean, cash in the bank is going to be either a liability of the bank, or if it's FDIC insured, it's going to be a liability of the federal government. So you got to think about, all these different things that people think of as safe ways to store their money. All have risks that are completely separate and different from owning gold. What are your thoughts there on that liability issue?
Well, I mean, there's no question. I mean, gold is no one's liability, but again, so neither is a piece of copper. So what we're getting into is you have to, once you've decided that whatever the insurance policy would address the risks that we're discussing here, which is the purchasing power of financial assets, ability to meet the obligations that has been taken over the past 35, 40 years, then you have to start looking and saying, okay, so there are a number of assets that work, but which of them are feasible? What is feasible? And again, it's for the Western mind, this is all like a new puzzle. But for Asian mind, it isn't. And it hasn't been a puzzle the mere fact that we're discussing it, that Warren Buffett is penning gold and we're discussing, we have to prove that this is something of value or of interest after the fact that it's been so for the entire history of human civilization. It's almost funny. I mean, it's almost just speaks to the level of simulacra of the world, which is sort of a reflection of the reality of the world in which we live, where things that are unreal are considered real, things that are untrustworthy are considered trustworthy. I'll give you a specific example. Banks, for example, the major too big to fail banks. I don't remember the exact numbers, but they've paid like 200, 150 billion, 200 billion of fines after the global financial crisis for crimes. I mean, I wouldn't call them crimes against humanity literally, but crimes against financial humanity. Let's put it this way. Money laundering, trading against clients, breach of trust, and it continues. I mean, Wells Fargo was just outed last year for what I think would be a fraud on a massive scale, opening accounts, using people's social security numbers to fraudulently open accounts, to create fees and do it on a nationwide scale across a global organization like that. And in none of these situations, no one has gone to jail. So I think the question people should ask themselves, I mean, is institutional trust, which for some reason continues to exist, despite ample evidence that maybe it shouldn't. And I would add to that areas in which you've spoken many times about Facebook and Google and even Twitter. I mean, and the information that's being collected and the breaches of privacy and the stories. Like, I mean, to the point where my wife, I have tweeted about it. My wife was talking to a girlfriend on the phone, and within seconds, the subject, one thing that they mentioned in the conversation, showed up on a Instagram feed. An ad showed up. Was it somebody was listening on the phone? I mean, I've been getting quotes for roofing at my my summer home. I'm flooded with roofing ads. How do they know? I mean, do you know what I'm saying?
Yeah, and I think that all of these things are interrelated. The popularity of Bitcoin and this backlash against big tech, what we're seeing going on politically, there's a lot of common themes here. Where people are tired of extreme authoritarian powers, on the part of whether it's, big tech or it's, politicians that don't listen to them and, are beholden to corporations. And, so I want to come back to the, where we started out and you saying that this is kind of a new to the Western way of thinking, because for the last, 50, 60, 70 years, we haven't really seen much turmoil on a political level. And we've certainly seen the markets just go one direction for the last 35 years. And people have a natural tendency to just extrapolate these things indefinitely into the future. But we're seeing a lot of signs that people are tired. And I think in a recent interview that you gave, you brought up a couple of interesting things, related to this, where I think you were talking about Vladimir Lenin had a couple of things that he looked for, that were required for social unrest or, social, revolution.
Yeah. Now, just to make a disclosure, whatever people, I mean, he was clearly a cannibal and a horrible figure in history, but whatever you want to say about him politically or ethically or morally, he was an expert in regime change, a successful practitioner as well. And so therefore, what his writings and his ideas should be studied for the insights. And what he said was the way he defined a revolutionary situation, which is a preconditions for regime change, is three things. Initially, he posed two, and then he added the third. So one was that the common people, or however you want to call it, proletariat or working people, are no longer willing to abide by the status quo. So they want change. We're seeing symptoms of that in the 2016 elections. We're seeing symptoms of that in the rise of the populist parties, what I mentioned to you, this Deutsche Bank index. The second condition was that the ruling classes lose ability to, or I should say, the tools, political and economic tools that the ruling classes have been using to manage the economy and the political processes stop being effective. I think we're seeing that as well. I mean, we're seeing that with central banking policies. We're seeing that with the inability to deliver real growth, despite multi-trillion-dollar liquidity injections. The third was that the dispossessed, or whatever, the aggrieved part of the population, which no longer abides by or doesn't want to continue, becomes organized. That we have not seen yet, but I think we may see that in the next elections. We saw the start of that in the fact that neither candidate of the major political parties has gotten much traction. I mean, of course, Hillary Clinton was nominated, but we now know that Bernie Sanders, who got a tremendous amount of traction in the primaries, was actively sabotaged, or his campaign was actively sabotaged by the Democratic National Campaign Committee. And so we don't know what the real outcome there would be. So the impulses that I see are definitely there. The other thing that the big argument that even my wife sometimes throws at me, it's like, well, you keep saying this stuff, but everything looks fine. I mean, look, people in the restaurants and everything's great, and the companies are making profits. And how what are you talking about? How can this all be so bad if it's all so good? If it looks so good? And what I think the answer to that is that if you step back and you just imagine for a minute how the last 35 years would have looked like in terms of the supply and demand for goods and services across the world without creation of these $200 plus trillion of debt that got created in the past 35 years, I would say that you have to say that the world economically would be a much smaller place, that there would be less demand and there would be less supply. So if we're discussing the potential outcome, or not the potential, the inevitable outcome of this debt binge, that the debts will, it's like with everything. There's a restructuring at the end of every binge. It's not Armageddon, and that's a big mistake that people make. They think, and this is where I can tell them, having survived, expropriation, and my family having survived the siege of Leningrad and World War I and World War II, and yes, horrible, but life goes on, and financial debacle is not decidedly Armageddon. It just isn't. Happens every 100 years or so, pretty much everywhere. And it's happened in the last 30 years across the entire Eastern Europe, Latin America, multiple places. Argentina is back there now. Venezuela is there now. Brazil is having issues. Israel has gone through hyperinflation. Zimbabwe famously did. None of these places life has ended there. People continue to have children and families, and yes, difficult times, but it's not Armageddon. And so that's why history is cyclical. People don't learn from history. They learn they look at their personal experience, and so they think that it's going to continue the way it is, and then they get surprised. I mean, I almost feel like it's public, like you or people who are telling people that things may go the wrong way. It's a way of public service. I mean, because everybody can afford for nothing wrong to happen. I mean, but who can afford for things to really go wrong? I mean, who's prepared? The culture of preparedness is gone. I mean, we used to have scouts. I mean, the scouts are still around, but I mean, the whole concept of being prepared for the unexpected. One of my favorite quotes is by Pericles from 500 years before Christ. I mean, this is 2,500 years ago, who said, it's not about predicting the future. It's about being prepared for it. That I think is what people should be thinking about, not trying to say this is going to happen and therefore I'll be fine, or that's going to happen. You should be prepared for whatever happens. And that's where the resiliency comes from. That's where the anti-fragility comes from. That's where real assets versus financial assets, non-digital versus digital, things that are lasting, things that are resilient to change and to adversity. Yeah, I don't see anything wrong with this message.
No, I don't either. It's funny how we feel like we have to qualify it somehow, because people think, oh, you're just a doomsayer or whatever. And I think I really, really appreciate you saying, we're not talking about Armageddon. We're talking about possibilities, and we're talking about change. And change, if anybody has read any history, is the only thing you can count on, right? Is nothing goes on forever. Things change. And so it's just a matter of looking at these trends and seeing what changes are these trends pointing towards. And I really do think your experience, firsthand in the Soviet Union is interesting for today, because you've seen some change, and most people like you point out, who have only known the United States over the last 50 years, don't know what real change looks like. And I'm not saying there's going to be some massive change, but I think it's worth looking at these trends and what are the possibilities going forward, because these things aren't sustainable. You talk about the great debt super cycle, and Ray Dalio has said in the last couple of years, this is the end of the great debt super cycle. So it's a matter of looking at what does that mean? What does that mean for markets? What does that mean for us as a society? And it's all interrelated. So I don't really, have any qualms about bringing this up. I think these are important discussions, and it's a shame that more people aren't having them. But I do want to.
Can I interrupt you? I had lunch with a good friend who made a very. His name is Bill Kennedy. He's the chief investment officer of Field Point Private Bank. He had a very insightful comment that I think. I mean, of course, we all know that, but he phrased it in a way that I think really brings it home. Media make money by overhyping bad news. If it bleeds, it leads, right? That's how media have made money forever. Newspapers, MSNBC, Fox, all of them. Financial media make money by overhyping good news or the positives. It's not cool to be negative on CNBC because financial media is in the business of helping securities firms that fund it sell securities. So it's all positive, positive, positive. So when people are used to bad news in the normal newspapers and TV and radio, but when it comes to financial matters, they, for some reason, see negative news as some sort of as a negative, as abnormal, because that's what they're used to. It's not about good news or bad news. It's about what's the reality here?
It's such a great point. How
right?
The psychology is totally reversed as soon as you start talking about money. I mean, I think, you just look at how people react when anything else in their lives, goes on sale, they get excited and go buy more. When it goes on sale in the markets, they freak out, right? And so it's kind of the same thing. And it's a great point too. Look at the incentives. It's always, an important thing to do when you're looking at anything. You look at the incentives behind most financial TV, and the incentive is, yes, selling products. And so
selling products. But, it's also important to look at what happened in the past 30 years with disincentives, which are as important as incentives. I mean, it used to be that companies like Goldman Sachs were partnerships. We're partners. We're personally responsible for the capital that they committed. I mean, we've this financialization of industry across the board, and the fact that management is compensated through stock options, which, by the way, is a policy decision. I mean, this was a policy decision. In the early 90s, it was the Clinton administration that that passed a rule that disallowed deductions over $1 million for executive compensation unless it was incentive compensation. So from now on, all the money is made in the stock market. So the managers are not necessarily interested in the owners of the companies who want to grow profits over an extended period of time in a robust, responsible manner. They need to make money now, so they want to juice up the stock price in the next 20 months or 12 months or 18 months, which is completely counterintuitive to what you would do or anybody would do if they were running their own hot dog cart or,
especially
or
when these companies borrow a ton of money to buy back the stock so that the executives have somebody to sell to. Right.
Well, and you know what? And here's a thought on that. So we started earlier saying that the federal government, is paying 30% of income taxes right now in interest expense. Well, I was talking to Luke Groman, who you probably know, who runs Forest for the Trees consultancy, and he sent me some charts. Actually, he made a great point that since that Clinton rule about the executive compensation, there's a tremendous correlation between income tax collections and the stock market moves up and down. And 5% of taxpayers pay over 60% of taxes. That is something to think about. So if 5% of taxpayers pay, so if you're thinking of a business and you're saying that 5% of its customers bring 60% of the revenues, would you think of that business as robust in terms of its ability to withstand adversity for a small group of its customers? Yeah. 5%? No. So where do these people get it? Why are they paying all these taxes, these 5%? Well, they're getting it from the stock market. They're getting it from the capital gains. So everything is hinged. So it's basically a hugely levered financial pyramid scheme. I'm not using this word as a criminal enterprise pyramid scheme. It's just by its nature and by its dynamic, it's similar to that because it just purely relies on the next guy taking you out, which is the biggest argument that Buffett and Munger have against gold. is that it doesn't produce anything. It counts on somebody else taking you out. Well, guess what? At these prices, most of these securities are in the same boat.
Yeah.
So,
well, I mean that explains a lot. I think Luke's thesis there, because there was an interview. If you've seen the movie Money for Nothing, which is fantastic about the crisis and the Federal Reserve's role in it. Janet Yellen gave an interview before she became Fed chair, well before. That wasn't used in the movie, but she basically goes on to say. This is maybe it was right after the financial crisis. And she said, we need to move from a society dependent on financial bubbles to stimulate our economy to something more sustainable. And so it's clear that, she understood before she became Fed chair, the risks of trying to create this wealth effect and boost, asset values to try and sustain the economy. But, when you look at, okay, what if we don't do this? What if we don't create a wealth effect? Then the pension situations are obvious, but then, the federal government is in a very similar situation as to the pensions. So, it might be that you're absolutely right and that Luke's absolutely onto something that, this is something we can't not pursue without creating a big financial debacle.
I don't think we can. And I think, just on the positive note to all this, the largest fortunes have been created throughout history during the largest debacles, right? Because the biggest opportunities, when the economy is like, look at what's going on in the economy now. Essentially, this financialization has given tremendous power to the largest incumbents, right? Who because they can issue debt most cheaply, they have the best access to the markets, they have the best legal protection against litigation. So none of the banks have essentially they paid off portion of their profits in fines, but they actually were not in any way inconvenienced or put in. Nobody went to jail, or no bank was closed on account of the depravities that they have perpetrated on the population, but when there's a disruption, which if you read history is just happens every 100 years or so, because humans are the same, because humans make the same mistakes over and over again. They forget and they do it again, and we are doing it again, just like all the previous generations before us did it. Those are the moments of the highest opportunity for the smaller people that have purchasing power that other people don't have. So, in the middle of the Great Depression in New York, you could buy office buildings for $10,000. I know it was a lot of money, $10,000 then, but it's incomparable to what these buildings were really worth. And either people didn't have the $10,000 or they were afraid to invest $10,000. But great fortunes were made then by buying those assets at that time. So all I'm saying is that people should try not to be emotional, but try to be practical about it and say, if I can't afford to be wrong about everything being right, what can I do about this? And by the way, if I do this, what do I get to lose and what do I get to gain? And what you have to gain is you potentially can participate in the greatest, fire sale of assets almost ever, given the level of leverage and technology that we've brought to bear here, where you wouldn't be competing with too many people for buying things. And so how can that be a bad thing?
Yeah, and I think, it's you make a really good point about the attitude towards a lot of these things, towards financial assets, towards gold, and from a very long-term, sentiment perspective, you just look at what, today passive investing has become so popular that it's, more than half the assets, or roughly half the assets in the stock market, are now indexed. And this is entirely predicated upon the last 50 years essentially repeating for another 50 years. And I think people don't understand that you're betting on there being no change, and you're also betting on maybe the last 35 years repeating. And how is that going to happen when interest rates have come down from 14% to 0%? How's that going to repeat?
It's not going to repeat. It's not going to happen. The next 35 years are going to be different. It doesn't mean that, life is not going to be happy eventually, but we have to go through a restructuring. We have to restructure the balance sheet. Everybody's looking at an income statement, but there's a balance sheet. The balance sheet is messed up, and it will be restructured either through deflation or through inflation or devaluation. I mean, there are many different ways to restructure the balance sheet, but value will be destroyed of financial assets and claims because every dollar of debt is somebody's asset. So if the debts cannot be repaid in real value, purchasing power, that means that the assets on the books are not worth whatever people say they're worth or think they're worth in real purchasing power either. So this is where gold, with its sort of unique properties, is simply a very effective store of purchasing power that is not implicated into the problems and is not correlated directly to the problems that we're discussing. And of course, we can do a whole discussion of gold itself and how to own it. That could be an hour in itself. Now you bring this thing with passive investing. I mean, has anybody considered, for example, that on the way down, it is usually the shorts who provide liquidity? Because they have to close out their positions, so they're natural buyers. And because all the shorts have, well, except for Jim Chanos and a couple of others, have been run out of the market over the past 5 or 6 years because they've been losing money consistently as everything gone up. Who's the liquidity provider on the way down?
Yeah, I mean, it's like you said, it's short sellers and active investors who might start to see value, and those guys have had all their assets pulled too. But yeah, you mentioned that we could do a whole probably episode on what's the best way to own gold. But for individual investors who are looking to diversify or at least ensure. Well, you make the great point that most of American wealth is in financial assets, and so pretty much everybody should have some type of exposure to gold as an insurance policy. How should just the average investor begin to do that?
Okay, gold is that brings us into all bigger discussion of which we're not going into right now of anti-money laundering and know your customer rules and difficulties with cash and the restrictions that have been put on the people's ability to transact in cash. So I would say that amounts under amounts like $50,000 to $100,000 or something like that. For investors like that, I think the best way to go is to buy coins in the most ubiquitous form that exists, which is probably for Americans. It would be American Eagles. I would, you would sort of you have to think in terms of like how you would use that at the worst possible moment, and you want something that people are not looking at and saying, well, I've never seen this before. So you want something that's ubiquitous and common for the territory where you are. So if you're in Canada, it's probably Maple Leafs. If you're in Australia, it's some Australian coins, some local coins. I would also say that it makes sense to own silver coins because a gold coin, even today, like a gold ounce coin, is $1,300 bill. Well, it's not very efficient to buy things with $1,300 bills if you ever need to do that. So for that purpose, I think silver coins, which are roughly $20 a piece, make a lot more sense. So everybody should own some coins, store them securely as you can, and don't tell anybody that you own them. Midnight gardening probably doesn't make a lot of sense, but for smaller amounts that could be safely and discreetly stored close at hand, that does make sense. For larger amounts, because of the anti-money laundering laws and because of the regulations, you need more organized solutions. I mean, so this is how I got into what I'm doing, because I couldn't find one for myself, and I created one. There are a number of solutions out there, but the guiding principles of everything you do with this particular asset should be very simple. You don't plug in backup generators into the grid. We just don't. There's no area of human endeavor, engineering, military, science, any area except for finance, where backup systems are created and designed to rely on the primary system, which is what hedging is. So when you hedge with securities, everything has to work, right? So systemic risk cannot be hedged within the system. And that's why you have to own gold in a way that is not correlated. And that's part of the issue with crypto assets, because even though they are independent from the financial system, they're not independent from the grid, and they're not independent from the internet. And access to the internet is controlled by several companies in the United States, actually. And as we know from China and from other countries, government has ability to prevent access to certain sites and certain things. So physicality of gold is one of the reasons you have it, and so you should own it in a way that preserves its value in that sense. So yes, that's what I would advise. But over $100,000, then there are other solutions that ought to be thought about more. International diversification, compliance is important, access to liquidity is important, and so forth.
Right. And so, and then in terms of, gold ETFs or something, they're obviously a liability of the ETF provider. And so that doesn't make them an effective hedge in that regard.
And not even that. I mean, if you look at an ETF chart and you see how ETF is organized, the liquidity providers, even if the gold is there, and let's assume everything is above board, but the liquidity providers of the ETFs are the too big to fail banks. So you're going back into the system which you're trying to protect against.
Right.
Furthermore, you hold electronic shares that are in DTC, which is digital, custodian system, which are in digital registration, that are held in street name by the broker dealer where you have your account. People are shorting some of these securities, so they're borrowing them. So you potentially have Lehman type situation where not enough securities to go around. I mean, to me, it doesn't make sense. It makes great sense if you're just speculating in gold.
Yeah.
You're just looking for exposure to price. That's fine, but it's not a safe haven.
Yeah. Well, have there been any books or papers or anything that have really been a major influence on your thinking in terms of any of this, your process?
It's really mostly personal experience. I mean, I just happen to. I mean, no, of course, I read history and the history of bubbles and understanding what happened before in the 20th century. And people should read about Mississippi bubble, which, by the way, is just stunningly similar to what we're experiencing right now. There was QE, there was financial repression, there was buying back shares at inflated prices. I mean, there was everything there. Yeah. Of course, that episode burned through in about 3 or 4 years. We have a much more sophisticated technology these days to let these things run longer. But it's my experience. I mean, it's the combination of understanding insurance, understanding credit derivatives and credit provisioning, and having personal experience with political and financial repression and expropriation, and just frankly, if you overimpose common sense on all of that and look around, you'd say, I mean, just the numbers don't add up.
Yeah.
They just don't.
Yeah.
It's simple as that. And people have faith that, they don't, but that somehow it's been going on and it'll continue. And think about your family. I mean, most of us are responsible for other people. So those of us who are responsible for children and wives and parents and whatever, it's not just about us. It's if you're wrong, you hurt people you love. This is not a pitch to buy gold. This is simply a pitch to open your eyes and step back and think for yourself.
Absolutely.
Look at the facts and think for yourself. This is what it's about. Yeah. Make your own decisions. Do the research. Read about it. Internet is full of resources.
Well, that's how I found you, and that's exactly why I wanted to bring you on the show, Simon, is because you do think independently of most of the other people and opinions, and especially this stuff you see on the mainstream, financial TV. We are almost out of time. I've noticed on your Twitter profile that you're a sailor, and it made me think of a quote. I can't remember if it was Thoreau or Emerson, and somebody asked him about contradicting himself. He said, I contradict myself, but I'm basically like a sailboat tacking from side to side, and I'm heading in the right direction generally. And I've always loved that metaphor. Are there, lessons from sailing and things that you apply to your thinking about the financial markets?
Absolutely. The most comfortable and the most peaceful point of sail is when the wind is behind you, right? When you have the wind at your back. It's true in sailing as well as in life. That's what the metaphor, may the wind be behind you. The problem is this is also happens to be the most dangerous point of sail, because it's true. It's true, because if you lose sight of where you're going for just a minute and veer in one or the other direction, or if the wind shifts just a little bit behind you and you're going straight downwind, what can happen is what's called an accidental jibe, which is where the boom comes very violently and very quickly across from one side of the boat to another side of the boat. And the forces in that case are so powerful that a lot of boats get capsized and what's called dismasted, essentially lose the mast. So as sailing as in life, when the wind is behind your back and you feel no threat and no pain, that is probably the most dangerous or the most risky, actually, direction where you're going. You're not noticing anything. And the other thing, of course, is if you're sailing with the wind, you're not feeling the full force of the wind, because the way the physics works is you subtract your speed from the speed of the wind. So it's very calm. You feel like there is no wind, where in fact there could be quite a bit.
Right.
So I would suggest that just when you're the most comfortable, and just when you feel the most gentle breezes on you, that's when the boom comes across and hits you on the head. I mean, that's
when you should be the most wary.
That's
right.
That's when you should be the most careful. That's right. Exactly.
Perfect. I appreciate that metaphor. I think it's very apt to the markets. Where can people keep up with you and your views?
Sure, I'm fairly active on Twitter. I've taken a few days sabbatical here because I almost feel like it's commenting on chronic condition. There are good weeks, there are bad weeks, but it's all the directions clear. You have to, there's not always everything to say every day. But anyway, I'm pretty active on Twitter. It's S_Mikhailovich is my address on Twitter. BullionReserve.com is the website of Tocqueville Bullion Reserve, and you can look up my background. And then if you just Google my name on the internet, there you'd see I did a TEDx talk where I, in 16 minutes, explain a lot of what you and I talked about here, not everything, but some of things. And I periodically do interviews on Real Vision, so those who are subscribers there can watch me there. I'm about to do another one. Of course, you can always reach out to me if you have any questions.
Perfect. And that TEDx talk was terrific. I sent that out to my email list, and I'll put a link to that in the notes that I'm going to put up on the blog when this podcast goes out. So
thank you very much.
Yeah, thank you for taking the time, Simon. I really appreciate it.
No, thank you for having me.
Looking good, Billy Ray.
Feeling good, Louis.
And that does it for another episode of Super Investors and the Art of Worldly Wisdom. As always, you can find notes and charts related to this episode at thefelderreport.com. Thank you so much for listening, and until next time, buy low, sell high.
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.